My name is Isabella Martirosian, and welcome to the third financial literacy event on credit and loans. Once again, my name is Isabella Martirosian, and I want to thank you all for coming this afternoon. I am the Vice President of Finance for the ASGCC organization. So I want to let everyone know that before we get started, the closed captioning and ASL interpreting are both available today. We have our interpreter Cynthia listed as interpreter Cynthia, and you could pin her video by pressing the three dots in the corner of her video and pressing pin. We also have our captioner Mark, who is going to be providing us with closed captioning, and you can access closed captioning by pressing the button at the bottom of the screen labeled CC. I would like to remind everyone that there is going to be $250 in Amazon gift cards being randomly given out today and at each of the financial literacy events. So please fill out this WooFoo form that I'm going to put into the chat right now. And in order to be in the running for one of these gift cards. So make sure you do that. Also, any questions that come up during the presentation can be sent to me, and we will have time to answer them at the end, so don't worry about that. We're going to go through the presentation, and then we'll have some time at the end for questions. So without any further ado, I would like to introduce Wesley Walton, the CEO of the Glendale Area Schools Credit Union. So Wesley, thank you for being here today.
Oh, it's my pleasure to be here, Isabella. It's wonderful. I like doing these. This is the third one that we have done. It is on credit and loans. Let me go ahead and share my screen, and we can get the presentation launched. And here we go. Okay, so we are, I'm once again Wesley Walton. I'm the CEO of Glendale Area Schools Credit Union. If you know, or if you've been to the bookstore on campus, our ATM, that's our ATM right there on campus in the around where the bookstore is. What else can I tell you about us? We're a credit union. We're like a bank, only better. We have better rates on shares and loans, and we are a not-for-profit financial cooperative. Means we don't have stockholders, we have members. If you are part of the credit union, you are part of the ownership structure of the credit union. So anyway, here's my standard disclosure. All of the opinions are of my own. If you need professional assistance, please seek professional advice from a tax advisor. So credit and loans. Well, let's just go ahead and deal with the loans first. It's a simpler topic. So, you know, why do lenders lend? Why does a credit union lend? Even the credit union, even though we're not for profit, we still are lending to make money, right? That's what we do. That's what our business. What do we expect? Well, we expect to get paid back. And so we lend money to members, you know, save and borrow among friends is a common saying in the credit union industry. So, but we, you know, our anticipation is we're lending you money and we're going to get paid back. And how do we know we're going to get paid back? Well, that's the trick. So we turn to credit and the credit factors that we talked about in order to make our best estimate is to know if we're going to get paid back. Okay, so let's dive into credit. So in general, I call them the 3 C's of credit: capacity, collateral, and character. As a lender, if we know you can make the payment, if we know that you're inclined to make the payment because of your character, if we know that if we don't get the payment, we can repossess collateral and get paid back that way, then we're going to make the loan. If for some reason we fall down on one of those 3, then it puts the loan in jeopardy. For instance, for collateral, for instance, if you want to borrow twice as much than the car is worth, then we're probably not going to make that car loan. So if we look at your income, and if you don't have money to make your payment, it doesn't matter how much you intended to make your payment. At the end of the day, if we don't think you have enough money to make your payment, we're not going to give you the loan. And then if your payment history shows that you don't really pay your bills, we're not going to make the loan. Because once again, we're just trying to figure out, are we going to get paid back? So when we go through the lending decision, we deal with capacity, collateral, and character. So what we want to do is we want to analyze prospective borrowers. We want to see if where they fit into capacity, character, and collateral. And then, then if we hit on all three of those cylinders, we are going to make the loan and hopefully get paid back. All lenders want to be paid back. We are not called gifters. We are called lenders. And so, but we want to try and do this as efficiently as possible. So we rely on shortcuts. So going to the first one, borrower capacity. Generally, people who have money, enough money in their budget, can make payments. So we just shorten that to what we call a DTI ratio, debt to income. As a quick sample here, if your payments are $1,700 and you make $3,500, and all these are monthly, then your DTI is 49%. So one of the things that we look at and we talk about, when my loan officers come in and they are wondering about a loan, it's like, okay, well, what's the LTV, what's the DTI, what's their credit score? Those are the three things we look at. So in this case, this person's DTI is 49%. So 49% DTI, it's a little high. If you have good credit and it's a car loan, it'll probably get past that DTI screen. But just FYI, if you want a conventional home loan, 49% is too high. You're looking at more at a 43% to get a conventional home loan for DTI purposes. But for a car loan, we'll go ahead and loan money on a 49% DTI. Okay, so we have capacity. The second thing is collateral, which we just simplify and shortcut to what we call LTV, which is loan to value, right? So if the loan, going over everywhere, hold on, let me back it up. I clicked when I shouldn't have. I clicked when I should have clacked. So the loan to value. So a loan to value just simply is how much you're gonna borrow. In the case up there, if you're gonna buy a $20,000 car, you put $1,000 down. That means you're borrowing $19,000 on the collateral value of $20,000. So your LTV, loan to value, is 95%. Once again, 95% is perfectly good for a car loan, but to do a traditional home loan or conventional financing, as they call it, 80% LTV is the requirement. So a lot of people ask, well, do you ever go over 100%? And the answer is actually yes. For car loans, oftentimes we go over the 100% LTV. We know that people have add-ons. We know that the dealer rolls in fees and taxes and DMV charges. So oftentimes, if you're a good credit financial institution such as ours, we will go ahead and put a 125% cap on our car. So we're not going to loan you twice as much as what the car is worth. We're not going to loan you 1.5 times what the car is worth, 150%, but we will bump it that 25%. So 1.25 times the value of the car, 125% LTV is what we will do when we're loaning money on a vehicle, as with a lot of other people. So, but like I say, if you're talking a home, nobody loans over 100% of the value of the loan, but in conventional financing on home loans is an 80% LTV. Okay, so let's go to the third one, character. We have capacity, we have collateral, and then we finally have character. Well, how do we know we pay your bills? Well, in essence, we've simplified it and we do this thing called FICO. FICO is just shorthand for how likely is this person going to pay us back? It's an algorithm. It was created by a separate company, and we pay money to use their algorithm, and they create this FICO score, and we make credit decisions based upon their scoring model. So they look at your credit history, and so just so you understand the players in this whole play. Okay, you generally have 3 credit reporting bureaus: Equifax, Experian, and TransUnion. TransUnion is more on the East Coast. Experian here is out more on the West Coast. And I don't know, Equifax is everywhere, or maybe they're just in the middle of the country. But if, as an institution here, we use Experian, we could just as easily use TransUnion, or we could use Equifax. In today's, internet connected world, we can use all 3 of them, but traditionally on the West Coast, 9 times out of 10, you're going to find the institutions use Experian. Point of interesting, if for those of you who care, when you do a home loan, they do what they call a tri-pull, meaning they pull from all three. So if you're doing the home loan financing, you're going to pull from all three. If not, you're going to pull from one out of the three credit bureaus. And what's going to happen is Fair Isaacs, who is the corporation that developed the FICO model, standing for Fair Isaacs Corporation, FICO for corporation. So FICO is from the Fair Isaacs Corporation. They are the entity that created this model that everybody pretty much uses for making credit decisions. Okay, so let's talk about FICO. The credit scores typically range from 300 to 850. Once again, FICO is an abbreviation of F for Fair, I for Isaacs, and CO for corporation. It changes when the information is updated. So it's based upon your credit history and some other factors. These factors are changing on a consistent basis. Generally, financial institutions update it once a month, but we all update it on a different day of the month. So it seems like your credit score can fluctuate back and forth quite a bit during a particular month. In reality, it's just that when the individual companies are doing their standard monthly reporting, it's just some people hit on the 5th, other people hit on the 15th, some people hit on the 22nd. So anyway, so it feels like it's kind of random. Generally, everybody reports at least monthly, but we all report at different times of the month. Okay, so the factors now, technically, the FICO is an algorithm, and while we don't, quote, know what FICO really is, over time, people have looked at it, observed it, seen people's credit history be changed or improve or not improve. And this is what everyone kind of agrees what the FICO model is. So this isn't from Fair Isaacs Corporation. This is just everybody else who's looked at a whole bunch of credit reports over time. And so that kind of want to give that disclaimer. So 35% of your FICO score is dependent upon your credit history. Do you have a 30-day late? Do you have a 60-day late? Have you paid it back? Did the lender have to charge it off? That type of thing. 30% of your FICO score is based upon the amounts that you owe. So if you owe a lot of debt, then the next debt that you get, you may not be as able to pay back as if you didn't owe a lot of people a lot of different money. 15% goes to length of credit history. If we're trying to predict the future, if we look back at 3 months worth of information, how do we really know? If we look back at 30 years and you've established a habit of paying people back, then they're more comfortable saying, yep, we can go ahead and credit them all the point values that we give for their length of credit history. If you have a couple, a year or so or 2 years, we're all like, yeah, we're not sure. We think we might, we think we might not, and your credit score will reflect that. Types of credit in use. So if the only thing that you've ever done is get installment loans, you buy furniture, or you borrow $2,000, you pay it back, you borrow $3,000, you pay it back. If the only type of credit that you have used in the past is one type, an installment loan, then maybe you can handle a mortgage, maybe you can't. Maybe you can handle a car loan, maybe you can't. Maybe you can handle a credit card, maybe you can't. But if you only use one type of credit, then your score won't be as high than if you have a variety of different credits. So if you had a car loan in the past, an installment loan, if you had a credit card, a line of credit, and you had a mortgage loan, that's pretty much, there's maybe another 3 or 4 other different types of credit out there. But in order to get the most value for all those, for your credit score, is you can't just have using a single credit. You have to use various types of credit. So like I say, a car loan is an installment loan. A line of credit is a way of what credit cards are. And so you can have lines of credit and not have a credit card. But you're looking for, okay, do you have lines of credit? Are you utilizing installment loans? Do you have a mortgage? And so that'll go back and forth. And then the final thing is new credit. Have you received credit recently, or have you applied around a lot? If you, for instance, if you go car shopping, you go to 5 dealers and you let all 5 dealers pull your credit, that will send your credit score south. Because the credit model doesn't know what you're going to do. Are you going to get 5 different car loans? So, the FICO is a measure of risk, and if you're out there shopping around and you let a whole bunch of people run your credit, then you're seen more risky than if someone just runs it once and gets that credit, gets that new credit added onto their credit profile. So anyway, payment history, what you owe, length of your credit history, the various and sundry types of credit that you use, and then what's happened recently. Have you put on 3 credit cards in the past 3 months, that'll tend to negatively impact your score for the next loan, because that's what they're looking at. The FICO is to determine how likely are you going to pay your next loan off. Okay, credit monitoring and credit help. The federal government many moons ago got together and said, hey, credit bureaus, you have to provide a free credit report. So if you just want a free credit report from one of the 3 credit bureaus or all 3 of the credit bureaus, you can go to the annualcreditreport.com. The annualcreditreport.com is required by the law. It is, first of all, notice there's nothing free in that title. If you look up free credit, don't look up free credit report, because it'll send you off on a goose chase and you don't want to be there. So if you just want your credit report, by all means, go to annualcreditreport.com. Don't get taken in by all the other offers. If you want assistance with your credit, I know, or if you want your credit report, your actual credit score, I know Credit Karma gives your credit score, and my son uses Credit Karma. He seems to like it. I actually have gone on to Experian, and on Experian itself, you can sign up and be a part of their website experience. By the way, I have not paid anything for the Experian, my access to my credit score and the information you're about to see through the Experian website, but they hit me all the time for premiums, upgrade here and buy that and click here to have more features, but I've done none of it. I've paid nothing to Experian so far, and here's what you can get for nothing from Experian. Okay, so when you sign up for free, and like I say, they're constantly trying to get me to do something. Couple things to note, here's all 3 credit bureaus, and you can get all credit scores from all 3 bureaus because they may have different credit histories. Occasionally that happens where Equifax or TransUnion will have a different credit history. So if you have a different credit history, guess what? You're gonna have a different credit score. And if you want to pay, you can get all 3 scores. But me, I just stick with FICO score 8 and I'm fine. By the way, there are different FICOs. FICO score 8 is an iteration of FICO. It's a version of FICO. They also have different flavors of FICO. They've got like car score and a credit card score and a installment loan score. So they have different flavors. For instance, if you are shown to have paid off your car, but you may be flaky with other things, you'll have a higher FICO car score. And you can pay for a FICO car, but we just pay for one basic FICO here at the credit union. But just realize that there are different flavors of FICO. In addition to versions of FICO, we're on model 8, but there are different flavors of FICO. So I am at an 830, right? And we can compare all 3 credit scores if we need to. So it basically goes into, a little bit of what FICO is and what they do. Once again, FICO score model 8, it ranges from 300 to 850. So what's helping my score? No missed payments, low revolving credit usage, I use my credit cards and I pay them off monthly, and I've got no negatives on my record. So if you get a foreclosure, if you have a bankruptcy or something like that, you will have a public record of that. So for me, I've got no negative factors impacting my score. If you want to, you can sign up through the Experian website and find out what you do. Now remember, you don't have to pay anything to Experian. You have to work at not paying them, but I think it's worth the time and trouble. So if we look at specifically my payment history, it's 35% of my credit score. Here it is. I've got no late payments, no collection items, no 60 days, and no derogatory public records. So I'm getting 100% of 35% of what my credit score could possibly be. The second area, the amount of debt, right? So my amount of debt is very good. I only use 2% of my revolving credit. In essence, for instance, if I've got a credit card with a $20,000 balance. So if I use only 2,000 of it, that's 10% of it. And I'm in the 500s because I actually pay off my cards a couple times a month just to keep them fresh. I only use 2 cards. I vacillate between 2 cards, and I only have about a little over $1,000 in debt the last time the 2 cards reported. Remember, this includes all of your credit utilization. So I have more than just the 2 cards, and that's all of my credit, all of my lines of credit combined. is I'm only using 2% of all of my lines of credit. I recommend that you don't use more than about 30% of your balance. If for instance, you have one credit card and it's say the credit limit's 10,000, the same thing would apply if you have two cards at 5,000. So if your entire credit limit is 10,000 and you have over like 5,000 in credit on that 10,000, your credit score will begin to be impacted if you've got a utilization rate of over 50%. I try and tell people to keep it under 30% just to make sure there's enough cushion on a month-to-month basis. Okay, length of credit history. Average account is, that's my average account is 13 years, and mine started 23 years and 5 months ago. So I probably have all the percentages of whatever they're allocating to my credit history because I'm old and crusty. Amount of new credit. 10% of my credit score is based upon new credit. So let's look at that. It's very good. I opened up a new piece of credit 2 years ago, 2 years and 2 months. That was, I think I was in Vegas, and to get free parking, I had to open up a credit card. So I said, sure, because I like free parking. Number of recent credit inquiries. We did an inquiry. Interesting, we're doing some technical stuff here at the credit union, and they're all like, hey, we love to pull a credit report live. And I'm all like, go ahead and use my account. I'm fine. I'm not looking for credit anytime soon. So they use my account to pull credit, and that'll drop off after, I don't know, 6, 12, 18 months, but no worries. So even with one pull and my credit 2 years ago, the amount of new credit is still very good. And finally, the credit mix, the final 10% is, yes, I've got revolving accounts. These are lines of credit and credit cards. Yes, I've had car loans and mortgages, and then the bank issued credit cards. So I have all three. Generally, back in the day when I used to when I had checking accounts, I would used to open up a line of credit and attach it to my checking account as an overdraft protection mechanism, and that's why I've got the revolving accounts, but haven't had that for a long time. So if we're talking about FICO ranges, sure, it can be from 300 to 850, but what does a good, what's a good, what's a fair, what's a very good, what's a poor? So here's a nice little table. So if you're under 580, it's a poor FICO. If you're above 800, you're exceptional. So here is kind of the description here. FICO is also used for what we call risk-based pricing. So in other words, if you have a low FICO, you get a higher interest rate. If you have a higher FICO, you have a lower interest rate, right? Let me go ahead and jump to the next screen for that. So we use it to whether or not we're going to approve the loan, right? That's one of the things that we do. But we're also for loan pricing. So if you have a 600 FICO, you're going to pay more for a loan than if you have a 700 FICO. If you have, we call it A paper, the top tier, which pays the least in interest, right? So we have tiers. Every institution can set their tier wherever they want to. This is my fourth financial institution, my fourth credit union. And if you look at what is available out there, generally people set their top tier anywhere between 700 and 750. 720 is a common top tier. I haven't ever been in an institution that set their top tier higher than 750. So if you have a score that's like 770, rest assured you will get the highest or the best rate available from the merchant. If you have a credit score somewhere in here, generally above 700, you more likely than not will get the best rate that that institution has to offer. A lot of people have cut it off. I've seen 720 as a common high tier cutoff. If you're below 700, you're probably going to, especially if you're like below 680, you're probably going to pay more. You won't be in the high tier. You'll either be in a tier 2 or tier 3 or B or C paper. People are using FICO to influence your insurance rates. So if you have a better FICO, you get a better rate on insurance. And then rental decisions. So if you've got a landlord, oftentimes landlords will pull your credit and they will look at your credit history. Primarily, they're going to look at your rent to income. So for instance, kind of like it's our DTI, debt to income ratio. If a landlord knows that you're paying 3/4 of your salary in rent, he knows you can't do that for very long, so he's not going to rent you the apartment. If you have income that's, you know, you don't have to pay 30% of your rent in your salary in rent, then the landlord knows that's about what normal people can handle in their budget. And then if they've got multiple people, hey, mine's 25, mine's 27, mine's, you know, 30 on the dot, they'll look at your credit report and perhaps a credit score to say, okay, I got 3 applicants. They all have under 30% rent to income ratios. Who am I going to rent it to? Well, perhaps the one with the better credit score. Okay, so tips to build credit and increase your FICO. Credit Karma does a good job at helping people do that. Other resources will be helpful as well, like the Experian before. They give you tips on how to increase your credit. But just to start off, if you have no credit record and you have no credit history, guess what? You don't have a FICO score. And that's kind of a bad thing. If you don't have a FICO score, we're going to probably put you in our lower tier, simply because that's what we're going to price you at, because we don't know. And if we don't know, we'd rather overcharge you than undercharge you, because if we're in this to make money, and if we undercharge you for your risk, we're going to lose money on you. So tips to increase and build your credit: have a good credit history. So pay your bills on time. No late payments, no collections, no bankruptcy, etc. Limit your overall advance on your credit cards to 30% of your overall limit. So say you want to, hey, I know I'm going to be doing, say, $5,000 worth of debt. I want to do something, I'm going to go out there and revitalize my backyard. I know I'm going to spend about $5,000 to do it. I have absolutely no credit today, but I've got a pretty good credit score because of whatever reason. Okay, well, I need to go out and get like $15,000 worth of credit, so that when I spend the $5,000, it's not more than 30% of my overall limit. So if you're going to use credit, or you're looking at using credit, yeah, you're going to get kind of more credit than what you need, only because you need a cushion so you don't impact your credit score negatively. The fourth item on there: keep your old accounts open. Unfortunately, they do look at your oldest trade record. So even though I don't use that credit card, I'm going to keep it open because I need to make sure I have an open account that I have a lot of length to. Variety of different credit types before. So if you only do credit cards, then you won't get your full advantage of that classification. So if you do a short-term installment loan, whether it's, however you want to do it, you can, do that and increase your credit score that way. And then by all means, each time you pull credit, it reduces your credit score. The funny thing about what I talked about earlier on how my one credit pull was due to what, we're changing some IT stuff in the back office, and so they needed to test. I got a notification from the Experian saying, oh, look, your credit score went down. How much did it go down? It went down 1 point. Okay, well, that was fine. But it is cumulative. So, if, my credit score, I think, went down 8 points because I had 1 credit pull. Well, if I had 5 credit pulls, it wouldn't go down 5 points. It would go down a factor. It would go down, 35, 45 points by having 5 credit pulls in a short period of time. So let's see. So because history is one of the things that they do look at, my advice to you is build your credit history early. And for an example, my son, as a senior in high school, got his first job. So I said, hey, let's go down to the credit union. Let's open up you an additional account. And so instead of opening up a checking account, which you think he would because he got his first job and needs a place to put his paycheck, we opened up a savings account, or he had a savings account open, but he did what we call a share secured credit card. So if you give us $600, we will give you a credit card with a $500 limit, and that deposit is securing the credit card. So it doesn't matter if you have no credit or even if you have bad credit. If you give us a deposit of $600, we're going to give you a $500 credit card so you can start to either build or rebuild that your credit profile. So he has done that. He's never been late. He uses the card and pays it off while using online banking and all that other things. He's now a senior in college, and he has a credit score above 700. So he's already started his credit building phase, and he will just be fine. But like I say, start building your credit union early. It's never too early to start. And if you, quote, don't qualify for a credit card, everybody qualifies for a share secured credit card. So that's how it can be done. Okay, so FICO mortgage loans, generally about a 640. If you're below a 640, your mortgage options go way down. If you're above a 640, if you're 650, 660, you may pay a little bit more than the 800s of the world, but you will get you will have the ability to get a conventional mortgage if you need to. Okay, so that's kind of all I had for today. Just your basic overview of what is a FICO score, how do people get loans, what do institutions look at, the 3 C's of a credit decision: collateral, capacity, and character. We can definitely know what your DTI is, your capacity to pay, your collateral. If it's a collateral-based loan, we can say, okay, how much are you borrowing against it? But then for your character, we turn to FICO. We also turn to if you paid us before. If you've been a long-term member and your FICO is bad, but you've always paid us, we definitely take that into consideration here at the credit union. But if we don't know you at all, we just have to look at the FICO as a proxy for, does this person pay their bills? So with that, Isabella, what questions can I answer for the group?
Yes, so let me scroll back up to the first one. Okay, so the first question we got was, could you please explain the difference between hard and soft inquiry?
Okay, great. So a hard inquiry is one that actually shows up on your credit as a credit pull. A soft inquiry is somebody who glances at your credit score, and they may do it to determine credit, but they can glance at your credit report in order to coach you up on how to improve your credit, or to tell you kind of what's there so you may be able to take appropriate action. So for instance, when you go into annualcreditreport.com and say, hey, I'd like to take a copy of my credit report, you're doing that for either educational purposes, or you're doing that for to see if you need to correct any errors. That is a soft pull because it doesn't show up as a pull for credit on your credit report. If a car dealership or a financial institution says this person has applied for a loan and I'm pulling a credit report to determine whether or not I'm going to extend credit, that is a hard pull on your credit report. So if you're applying for a loan, it will be a hard pull. If you're just doing it for educational purposes, if you're doing it yourself through annualcreditreport.com or through a credit monitoring device, it's a soft pull.
Okay, awesome, thank you. Next question was, what is better, to have a credit line from a bank or from a store? What effect will a store credit card have on a credit report if it is paid in full or partially?
Correct. I do not believe, okay, maybe FICO in its algorithm ranks bank issued credit cards above or below a store issued credit cards, but my best guess would be that the store issued credit is identical to a bank issued credit in all of its functions. It's a line of credit. You will have a percentage of that advanced at any one particular point in time. You have to make monthly payments. So it should function identical to a bank issued credit card. Technically, I don't know that to be true, but my gut says, yeah, there's no difference between a bank issued card and a card that's issued by a retailer. However, nowadays, for instance, if you go get a Home Depot card, it's not backed by Home Depot, it's backed by some bank that has chosen to partner with Home Depot. So if you're talking about in today's society, very seldom will the department store actually have a card. It's a third-party bank that will do that. For instance, when I got my credit card in Las Vegas, it was an MLife card from one of the casinos. It wasn't really from the casinos, it was from a bank out of Utah, right? So like I say, today you won't have very many actual department store cards anymore, simply because they're backed by a bank anyway. So.
Thank you. Next, if a person does not have any credit cards, where is the best place to start at, and how can we build a credit score fast?
Correct. So like I say, my son, he did a share secured card. So because he was working, he had the $600. we we gave him a credit card based upon that share secured deposit, and therefore he got a card that same day, or he got one ordered and shipped to him shortly thereafter. So that's the easiest and fastest way, is to go in and get a shared secured credit card. When you do so, like I say, once again, recognize that you're only going to spend a very small fraction of that balance on that card. Because remember, if he spent like $250, that'd be 50% of the credit line, and his credit score would get dinged. So, funny story. He worked all summer to buy a computer for himself. And so what he had to, because he only had a $500 credit card, he went into Amazon. He'd like order the motherboard. The charge would come in, he'd pay it off. Then he'd order the next piece of his computer. The charge would come in, and he'd have to pay it off. So as long as you pay off your card before the month cycles, before the credit report cycles, it'll report whatever balance it is at that time. So he's been able to keep the reported balance low, even though he like I say, bought a lot more than $500 on the card over a particular month. He paid it off so that the balance at the end of the month that gets reported to the credit reporting bureaus was low or zero. But anyway, to establish credit, the fastest way, do a secured credit card that doesn't require any credit score.
Great, thank you. This next one, I just also sent it to you in private chats, a little long, but I'll also read it out loud. It says, I have collateral-owned asset, high FICO, and wanted to get a loan of less value than owned asset. However, due to no current income as a freelance worker, coupled with career uncertainty of COVID, uncertainty in real estate, 2 banks and 1 credit union said no, and they will give a home loan with no current income. They are being hyper financially conservative. What can I do to get a home loan? Can I get a SBA small business loan and use that, or is there another way?
Okay, so once again, like I said, the 3 C's, one of the 3 C's is capacity. If you don't have any income right now, we don't really care about your credit score, because we get paid off the cash you make. And so we have to be relatively confident that you're going to have that cash to make those loan payments. So yeah, that's why we don't get people that are, loans to people who've been recently fired or laid off. Because like I say, we're looking at that capacity C. Does the SBA give you something? The SBA program is a little different. My gut tells me it's going to be a tough row to hoe to get an SBA loan, considering you have no income. I mean, you have to have income to make your payments. That's kind of the crux of one of the C's. You have to have the capacity. And so, that's, especially on real estate, which is a long-term loan and a loan that has, has a lot of risk in it because of the dollars are big. I would say that, you have to have some credible indication, story, evidence that you're going to have the ability to make that loan payment on a month-to-month basis. So if you have a business now, sure, you're going to need something to show that your business is going to be profitable and that you'll have the cash flow to make that payment. Yeah, obviously the reasons why the other institutions and the credit union, could have been us, didn't make the loan is because we're not seeing income. And without income, how are you going to make the payment? That's kind of the hard and the fast. However, in today's situation with government assistance, and the government is handing out money through the SBA lending program to people who need money but can't necessarily show that their business is making a profit today. I don't want to tell you that it won't happen through SBA channels, but if it was going to happen through SBA channels, we have a link on our site. So if you go to gascu.org, we're an organization. So if you go to gascu.org, there is a business loan button in the upper right-hand corner of our website. It takes you to our SBA loan partner. If there's anybody that could give you an SBA loan, it's them. They are a fintech broker. where they're an aggregator. So they have many different SBA lenders that will look at your application. And if that to me would be your best shot at getting an SBA loan is going onto our website, clicking on the business loan link, going through their online process, and hopefully, well, two things. Number one, there could be a program under today because SBA does have distressed business loans currently. And or number two, if the government goes to another round of PPP or additional COVID assistance to businesses, you might qualify under that. So if you haven't done an SBA loan application, by all means, go onto our website. You'll find one there, and hopefully, if it's a business type loan, they'll be able to help you out. But as far as a traditional mortgage, like I say, even if your LTV is good, if you only want to borrow, 40, 50% of the value of the thing, we will generally decline because we still want to see your capacity to repay, which is how much money do you make versus what all of your payments are.
Perfect, thank you. And I also, I don't know if any of you saw, but I put the link to the website in the chat, just so you all know. Okay, next question. Banks want to do a soft inquiry to increase the credit line increase, so it will not make any harm on my credit report, correct?
Correct. If they're pulling your credit for credit monitoring purposes, then it is a soft pull and will not hurt your credit. A hard pull is for if they're going to be advancing you new credit. So if you said, could you please increase my credit line, then that would entail a hard pull of your credit because they're going to be advancing you new credit. So if all they're doing is just doing it to monitor, it's a soft pull, but if they do it because you want to increase your line of credit, it will be a hard pull.
Okay, great. Next question said, did he say to have 3% revolving credit ideally maximum, or was it 30%?
30.
Okay.
30. So like I say, if you have a $10,000 credit card, try not to spend more than $3,000 over the month end, over the reporting period. So yeah. So it's when the institution reports your credit, which you may not know when that is, but it's definitely under 30% of the credit limit. So that's why, unfortunately, say you've got two cards. Yeah, I have two $5,000 cards, and I've got, call it $2,500 on one card, right? I have $2,500 on one card. That card limit's $5,000. But I have another card that's $5,000, and it's a zero balance, right? So total, I have $10,000 on two cards, and I only have $2,500 borrowed on that one card, right? So I'm good. My credit score looks fine. It responds well. It's it's high. And suddenly I said, you know what? I don't need that other card. So I close out that other card. Well, guess what? My credit line just dropped from 10,000 down to 5,000. Well, now what is it? Well, now it's only, it's 2,500 off of 5,000, and suddenly my credit score gets whacked because I told the issuer to close out one of my credit cards. That's kind of one of the, no good deed goes unpunished. You'd think you get a benefit to say, look, I don't need that extra credit, right? But unfortunately, that's not how the algorithm works. The model is, percent outstanding versus total credit line. If you got rid of that one card and drop your credit line, then suddenly your, the ratio is you got a higher percentage of balance and your credit score goes down. So weird things like that happen, but that's just how the algorithm works, how FICO works.
Great, thank you. Our next question says, if you have I think this means if you have a store credit card and they went bankrupt, what should we do with that credit card?
Probably if you had the credit card and, first of all, is the account still open? A good way to check is go take a look at your credit report. So if you look at your credit report, either the account may have been closed by the department store, or the account may still be open. If the account is open, I would just cut up the store card, but there's no reason to close the account unless you want to clean up your credit report. And sometimes it's good to clean up your credit report. But my my guess is that if the store went bankrupt, they probably, that your account relationship has value, and they could have sold their portfolio for greater than its book value, greater than its amount, to a third party. So, I don't know, maybe a bank bought the department store's loans, including your account. That's definitely possible as well. So if you want to know, I would say go ahead and get a copy of your credit report, either from annualcreditreport.com or from the other vendors, Experian or Credit Karma, and see what that account looks like on your credit report. If it could already be closed, and so you've got a card in your wallet that you're just carrying around, but it actually doesn't work. But if the account is open, there's no reason really to close it necessarily, or it may have been purchased by another bank or financial institution.
Awesome. Our next question says, it's a little long. It says, when I first came here, I wanted to open a credit card at Best Buy. They processed it and then said that because of my low credit history, they gave me a card with monthly payments. But because they can process the card for my husband without a monthly fee, I decided to close my card immediately after 10 minutes from when I opened it. At the time, I didn't know that closed account may affect my credit history. Until today, I see this closed account on my history. Does this incident affect my credit history, and how?
It was probably the credit pull that affected your credit score more than closing the account. Like I said just before, if you close your account and as a percentage of the credit limit, that would affect your credit score. But if you just did it for 10 minutes, it'll be just a slight, devaluation of your FICO for a short period of time. But yeah, opening up an account and then closing it in short order won't affect it. I mean, yes, it will affect it, but it won't affect it that much. And time will kick it off your credit report probably in 6 to 18 months.
Perfect, thanks. Next question says, if someone's credit card limit is 500, how much amount should they use from their credit card in order to secure a good credit score?
Right, so it's basically 30%, so that's $150. So remember, it's not the use of the card, it's what's the balance when you report. We report at month end. So even if you say you charge $400 on the credit card, if you pay off $300, and so at the end of the month before we roll our statements, the balance is $100, well, that's only 20%, and so you're good. So it's whatever the balance is when it gets reported, and that's try not to have it more than 30%. If you want to make sure you're safe, that's $150 on the $500 card.
Great, thank you. Next, do I have to have at least 2 years of tax returns for making any loan or refinance for my home loan?
If you're talking about real estate, yeah, they like to see 2 years worth of tax returns. So real estate loans are looked at a lot more strenuously than credit cards or car loans. So they will need a minimum of 2 years tax returns.
Great. Okay, next, what is APR in your credit union? Do you have a promotional period, and can we make balance transfers?
Correct. So the APR is the annual percentage rate. If you're talking about our credit card, we have a fixed credit card for a low rate of 9.9%, and that is for our tier 1 people. Obviously, if your credit score is lower, we charge you a little bit more. Unlike a lot of other credit cards out there, our rate's fixed. So it's a fixed, call it 9.9% loan. So even if interest rates go up in the market, your rate will stay the same. But the best deal, no matter even if your rate's a little higher on because of your credit score, if you do a balance transfer, it's a flat 7%. So even if your credit score may be a little bit shaky, but you say you do use the cash advance feature and do a balance transfer, that is locked in at 7%. So we don't do, I call them bait and switches. We don't do any promotional rates. We don't do any 0% or 1% for any particular length of time. The rate that we give you up front, the 9.9, that's for the life of for the credit card. If your credit score is tier 1, even if your credit score isn't tier 1, you do the balance transfer, you are locked in at 7% for the life of that loan.
Okay, thank you. Next question, if we're not using a credit card, how do we double check for identity theft?
Okay. Well, you can always go into, well, get your credit report and see if there's unknown credit that someone else opened up on your behalf. So if you want to check for identity theft, you can go in, pull your credit report, and they will let you know if there's credit that you haven't opened. The second thing is, for instance, if new credit gets opened, for instance, for my situation currently, because I'm signed up with Experian, if my credit score goes down like it did because they did the poll, I get a notification, hey, your credit score dropped. Do you want to go in and take a look at it? So if you want something more online real time, you think about opening up, going on to the Experian website and going on to their system. The third thing that happens is I get a call from, I don't know, somebody about 7, 8 years ago now. Hey, were you applying for credit over here? It looks fishy. And basically someone tried to open up credit in my name. So I was a victim of identity theft. And that was their fraud people reaching out to me and say, this guy with your name is trying to open it up in some place I don't live, Midwest, East Coast. And so that's like, that it was good that they did that because they didn't grant the credit, and I was able to do a whole bunch of identity theft stuff with the credit bureaus. But long story short, that's, sometimes the fraud people of these places reach out and say, was this you? Because we don't think it was. But if you want to do something that's a little bit more proactive, by all means, sign up with somebody, and they will let you know if something's happening with your credit score drops or whatever, and then you can go in and take a look and see what happens. And obviously, if you sign up with Experian, you get to go take a look at your credit report initially to see if there's credit out there that either maybe you forgot about or perhaps that was open in your name without your knowledge. So that's a twofer if you do the Experian thing.
Thank you so much. Our next question, will my credit score be affected if I had my credit score checked by 2 separate real estate brokers?
Yes, once again, if they pulled your credit, they are checking your credit to extend you a loan, and those are hard pulls, and that will affect your credit score. So yeah, just be aware of that.
Okay, great. Our next question, is there a way to find out exactly when, for example, day of the month, when each credit card companies report?
Not that I know of.
Okay. Next we have, is it just the life of that loan? Therefore, if I only transfer $2,000 once I pay that off, will the interest rate now go up for other regular purchases after that?
Yeah, well, if you do a cash advance for you paying off another card at some other place, that's 7% for the life of that balance. If you do the regular purchases, yes, it will be the 9.9. If you want a car loan, our best rate's 1.99 for 60 months, in case anyone's interested.
I think for now that is our last question that we have, unless anyone else has any other questions. Oh, someone says, if they're concerned about identity theft, you can also freeze your credit card through bureaus.
Yeah, but they want to charge you for that.
Oh, okay.
So as a victim of identity theft, I got kind of that service for free. I don't recommend it. It's unsettling to be a victim of identity theft, but hey, life goes on. Like I say, if you're concerned, because I did this Experian thing, I actually am very comfortable now knowing that if something happened to they're sending me like weekly things about, hey, you can better insurance rates and this and that. But the whole, hey, your credit score dropped, check it out. I would be comfortable telling anybody, look, go do that. They'll do it for free. You don't have to pay for it. And if anything happens to your credit score, they will email you and let you know. And that's probably the first thing that's going to get hit is your credit score is going to drop if someone's trying to pull credit on you that you don't know about. Yeah, the good news is that if you're a victim of identity theft, you file the police report, and everybody's pretty good about, you know, not attributing to you debt you didn't pull.
Okay, great. Okay, we have another question. If there is more money on my credit card, for example, if the limit is 2,600, but there is more than 2,800 in my card, how will this affect my credit score?
Got it. It'll whack it pretty good. So if you're over the limit, you'll just get dinged that much more. So obviously, if you have, you know, 50% of the limit and 70% of the limit and 100% of the limit, okay, you get whacked. But if you're over the limit, yeah, you get an extra beat down with the FICO stick. So I would say try and get it under the limit as quick as you can. Hopefully, like I say, if you can get it down to that 30%, you're doing well. But if on any individual card, if you're over that card's limit, it's going to impact your FICO. That's not a responsible use of credit. You should have known how much you had. You went over. You're going to pay the cost of that.
Okay, awesome. And then our last question will be, since we only have one more minute, do we need to be a resident of Glendale to be part of the Glendale Credit Union?
If you are going to school at GCC, by all means, you can join. We would be happy to have you.
Okay, we'll do this one last one. So can someone get a loan to buy a house with 0 down payment?
Yeah, there are still, FHA, the Federal Housing Administration, does have programs for 0 down. There's also, if you're a veteran, VA is legendary on its 0 down programs. So if you haven't served in the military, then you have FHA, and there's a small slice that it's still 0 down from FHA, but there are pretty stringent requirements.
Okay, awesome. Thank you. So that will be all the questions we'll have for today because we are now out of time. But I want to thank Wesley again for being here today to deliver this presentation. Again, to our interpreter, Cynthia, and our captionist, Mark, for their services this afternoon. And thank you to everyone for your questions, of course. I want to remind everyone that we'll be having one more financial literacy event this fall on November 5th, next week. On credit and loan, or not, sorry, that was this one, on the economy and investing. So make sure to come out to that one. There is more information on that event on the upcoming events page on the ASGCC website. Also, remember to fill out the WUFU form that I put into the chat earlier. I'm going to put it in right now again, in case you don't have it, to be entered for the gift card giveaway. And yes, so I want to thank you all again for coming so much. So have a good rest of your day.
Thank you.
You're welcome.
Of course, thank you for coming.
Thank you.